Welcome from me, Guy Monson, to our regular 6-minute strategy. The first UK election poll from YouGov was released this week. It shows Labour on track to win a crushing majority of 194 seats. Not only would this exceed Tony Blair's majority in 1997, but it would, according to YouGov, be the second largest parliamentary majority in British political history. Global investors would have traditionally been highly nervous at talk of a Labour landslide of this magnitude. Today, though, almost the reverse seems to be true. Since Prime Minister Sunak announced the election on May 22nd, the pound has risen, UK gilt yields have fallen, while the FTSE 100 has been the world's best performing major equity market this quarter. We're even seeing a sharp uptick in UK M&A activity, which has recovered sharply in 2024. So why are investors so sanguine? Well, probably because both Tory and Labour economic policies are now more or less identical. Labour proposed no increase in the current rates of income tax, national insurance or VAT, and will cap corporation tax at today's 25%. They will even keep the Tories' fiscal commitment to reduce debt to GDP ratios by the 5th year of the new Parliament. In short, all change politically for no change economically. In the slides ahead, we'll look at what this extraordinary policy coordination means for investors and where the real risks might lie for a government in waiting. So let's begin by looking at two great charts from the Resolution Foundation, looking at the economic record of this government. The first shows 18 administrations back to 1955 and the change in average real household disposable incomes that we've seen through the governing period. Every one of those is positive until we reach this government, and you can see the decline there in that blue bar on the left. Yes, we've had wars, yes, we've had pandemics, yes, we've had energy shocks, but the numbers are very graphic. On the right-hand side, they look over the last 5 years at our comparison economically to other members of G7. On the left-hand panel, inflation. Over that 5-year period, UK inflation is the highest at 24%. If you look at growth, change in real GDP, we're not quite the lowest, Germany is below us, but at 1.7%, we're well away from the US there, growing at 8.7%, and even Italy, Japan and France. The third allegation that I think can fairly be made against this administration is it's taken the tax burden to its highest since World War II. Now, we've seen this chart before on these talks. It's from the Office of Budgetary Responsibility. It's national account taxes as a share of GDP. Coming out of World War II back in 1948, we were around 37% of GDP. As we go forward to today, we're around about 36%, and we'll probably go through that target sometime in 2027/8. As the IFS, Institute for Fiscal Studies, said, for a Chancellor with a goal of reducing debt as a fraction of national income, things have really been so bad. So let's turn the tables now and ask what the Tories would say about their own record. Well, first of all, I think they're right to boast a little bit about inflation. From the highest rate of the UK 18 to 24 months ago at over 11%, we've now fallen to 2.3%. That's below the CPI in the US, the Euro area or Japan. If we look forward to the Bank of England projections, we'll be close to 2% by the end of 2024 and through it in 2025. That's quite a turnaround. Secondly, I think despite those challenges of real household disposable income, real wages are at last beginning to rise. You can see that number on the left-hand panel of 2.5%. So I think looking forward, Prime Minister Sunak will claim that this will improve and his record on real wages will be better. On the right-hand side, we've looked at this before. This is the PMI data. Anything over 50 is a survey showing growth. Under 50 is contraction. The UK is sitting there nicely in the middle at 52.8 for the composite reading. Spain, Brazil, the United States lead on the numbers, but we're well ahead of the Euro area, EU, Ireland and France. So the argument is that growth going forward could be better than expected. What will now face both governments when the new Chancellor walks into his office? Well, first of all, I think he'll look at the debt picture. And what is worrying is, yes, debt is very high, but getting it down is going to be particularly difficult. To be successful, you either need strong nominal growth to shrink the GDP ratio to debt, or you need low debt charges, low interest rates, or low debt as a proportion of your total budget. I'm afraid we're going to get neither of those. In the chart below, I show on the x-axis average annual nominal GDP growth, and on the y-axis I show average net interest rate as a proportion of spending. Blue dots are Tories, red dots are Labour. Where you want to be is in the bottom right-hand panel, high growth and low interest charges. Where are we? Well, the forecast made in March would suggest that we've got both low nominal GDP growth and relatively high interest rates. And that's going to be very hard as a basis to squeeze debt. So what does all of this outlook mean for the financial markets and for the UK in particular? On the left-hand panel, I've shown the PE multiple of the major regions of the world, 22 for US equities, 17.5 for global equities, and just 11.9 for UK equities. So very, very cheap. Perhaps this is behind the surge in M&A that we've seen already in 2024. The UK would be in an even better position if leadership in world markets changed. As long as growth stocks dominate the returns, the UK with a very small tech sector will not perform. But if small cap, value or particularly dividend yield came back as a style, the UK would be comparatively well positioned. So let's wrap this up. Near identical Labour and Conservative economic policies means that surprisingly in this election there is very little economic risk. After all, Labour have committed to not raising income tax, national insurance or VAT, capping corporate tax at today's 25%. They have a long-term target to lift defence spending to 2.5% of GDP. They will keep the Conservatives' debt target, and yes, they've brought the decarbonisation of power forward by 5 years, but the trend is still the same. In terms of Europe, both Labour and Conservative want closer ties, but neither support free movement of people or rejoining the customs union. So yes, all change politically for no change economically. So what are the implications? UK election risk is low because the policies are so similar. Sterling should continue to benefit, the UK market should continue to re-rate upwards, and expect further rises in M&A. Finally, UK corporate bonds yielding around 5.5% are attractive because of the big surpluses in our pension fund. So yes, these are hard times. Yes, this is a very tough election, but economically, I think we're a little bit better off than we might have dared expect. Thank you.